Hey there, everyone. Today on the final bar, choppy session. The major average is basically unchanged for the day. The 200-day moving average continuing to loom large below current levels for the S&P 500. We'll talk about the resilience of the semiconductor group. Why is this group so vital for market health? Finally, we'll be joined by Jesse Felder of the Felder Report. What can market valuations tell us about the current environment? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. The Technical Analysis Toolkit really is focused on the evidence the markets provide back to us. I was interviewed earlier today and was being asked about the general principles of technical analysis. Now, why are breadth indicators meaningful? What does it mean when this sort of price pattern happens? And I kept going back to the idea that it captures market behavior. It captures investors and all of their buy and sell decisions, all of those decisions fueled by emotions like fear and greed, I think are aggregated into price action. And by analyzing those price trends, we can understand the shifting tides, or what I call the change of character, when a market rotates from a bullish phase to a bearish phase and back again. Now, sort of an unchanged day, a choppy session for the S&P and the NASDAQ. At the end of the day, finishing slightly lower, but not a real significant move. There are some significant moves out there. We'll talk about two groups in particular. Consumer staples getting beaten down in a big way today. Some of those charts like Molson Coors, ticker TAP, dropping pretty significantly. The latest downward step in a long downtrend. Other areas of the market like semiconductors for now maybe holding up. Let's talk about some of the signs we might be looking for. With that in mind, let's get to our market recap and see how the charts have evolved in the last trading session. Before we get there, we asked you recently on our social media accounts and here on our YouTube channel, what would you feel most comfortable shorting right now? Now, I didn't give you that fifth option, which would be nothing. So you have to pick one of these things, right? Stocks using the SPY, bonds using the TLT, gold, GLD, or Bitcoin. 49% of you, almost half of you, said you feel most comfortable shorting stocks at the moment. Now, I didn't give you a time frame, right? We didn't say shorting stocks over the next hour, over the next day. We just said, what would you feel most comfortable shorting right now? I would tend to agree, although bonds are a close second. I think when you look at the overall trends that are in play, I would argue that higher rates and weaker bond prices certainly seem to be a pretty consistent trend that I would assume is going to continue beyond what we've seen so far. So I might pick the TLT as an option. But I agree with, I can see the argument for the 49% of you saying the SPY. Let's look at the chart of the S&P 500, the NASDAQ, and others, and see how things played out through the course of today's trading session. As I mentioned, sort of a choppy, noisy day, but at the end of the day, directionally, no real progress for the S&P 500. Closing just below 4260. This is down about 0.1% from yesterday's close. About the same slight down move for the NASDAQ composite. But again, overall, holding ground pretty well. The NASDAQ 100, which is more the mega cap side of the NASDAQ, down almost 0.4%. So a little bit weaker in the larger names than the smaller or maybe more mid-cap names in that in those indexes. Mid-caps and small caps all down about the same amount, so no real clear differentiation between those. And as the market finished slightly lower, volatility continued to come off, but not by much. Still above 18, still below 20. So, we're still at sort of the upper end of the range we've been for the last couple months, still below that crucial 20 level. And earlier, over the last week, we did trade for one day over that 20 level. We haven't closed above there yet for this point in the cycle, but for now, I think the VIX remains a very important chart to watch, right? If you ask me, what are those signs that would tell you things are really starting to decline in an aggressive and not so positive way? The VIX spiking above 20 would be one of those red flags that I would immediately start to look at. So as a reminder, I would encourage you, good time to use our alert engine. Click on the alerts button in the upper right corner of your dashboard. Set an alert for when the VIX gets above 20. It's not a perfect trading system by any means, but I guarantee you're going to want to know if and when, and probably more when than if that movement would occur. Interest rates, a bit of a mix. The long bond yield just slightly higher, 10-year yield slightly lower, and again, not big changes anywhere in these asset classes just today. Long bond yield just below 4.9%, the 10-year yield just above 4.7%, and about the same for the 5-year yield. With short-term rates still above 5.25, where they are currently at, we still have that inverted yield curve. Again, one of the best predictors of a recessionary period. And while I've heard a lot of discussions telling me why this time is different, I've often found that justification is usually not great. That usually tells you you're ignoring something clear if you're ignoring a signal like that. So I think the inverted yield curve is certainly a cause for concern. Bond price is down by about 0.5%. That's using the TLT. And the UUP, a dollar ETF, was down just about 0.33% from yesterday's close. Let's look at the commodity space, mostly in the red, but a couple things like natural gas prices actually bouncing higher. Crude oil continues to come off, so the USO is down another 2% today. Energy stocks certainly have given back a lot of their previous gains from earlier in 2023. One of the strongest places to be, certainly in the third quarter, was energy stocks, giving back a lot of those gains now here and rotating lower as crude oil prices have really started to pull back. The long-term trend in crude oil in terms of higher oil prices could certainly be the theme, but in the short term, we're seeing some deterioration there. That's dragging some of the broader commodity ETFs like the DBC down, which is down 0.6%. Gold and silver prices down again, but slightly, not a huge move lower for the GLD or the SLV. Finally, in terms of cryptocurrencies, mostly in the red. You had a bit of a spike higher earlier in this most recent 24-hour session. Bitcoin price is currently just below 27,500. Ether price is holding just above 1,600. And again, it's interesting. We have additional news flow just this week. We have the new Ethereum futures ETFs. So they're not ETFs based on physical Ethereum is not a great. That's sort of a contradiction. But actual Ethereum. It's not like the GLD where it's based on physical gold. These are based on futures, just like Bitcoin has a Bitcoin futures ETF. And again, it's sort of getting closer to an ETF product that is directly linked to the price of Bitcoin and Ethereum, but it's still one level away, right? It's linked to the futures related to Bitcoin and Ethereum. I would argue the big long-term thesis on things like Bitcoin and Ether are broader adoption, and I would say broader interest from investors is only going to come when you have ETFs that are based off of the actual Bitcoin and Ether prices. So still to be determined, not happening today. Finally, looking at the sectors, real estate at the top of the list, and not many times I've been able to say that in 2023, but here's the day, up 0.7%. Healthcare, number 2, up 0.6%. Financials, number 3, up 0.5%. So 3 sectors we have rarely seen at the top of the return list, all there today, which is pretty interesting. On the bottom, I mentioned consumer staples really getting rocked today. The XLP was down almost 2%. Materials were down 1.25%. Energy, industrials, utilities following nearby, all down about 0.6% for the day. Let's go to a daily chart of the S&P 500, just kind of check in on what happened today versus the overall trend we've been in. Undeniably, I would say the market is in a pullback phase. The question is how deep, how long, how far does this corrective phase occur? Some of my conversations have had wide-ranging answers to that question. I'm excited to talk to Jesse Felder about how he is making sense of this pullback after such a run in the first half of 2023. Certainly things starting to change. The S&P in terms of key levels, 4,200 is kind of it. It's the 200-day moving average. It's the first Fibonacci support level, which is technically just below there at 4180. We're kind of right there. We're a rounding error away from that level. So I think as long as we hold that 200-day moving average, again, around 4,200, things are just not getting that bad. And certainly going forward, as the 200-day continues to slope higher, holding that 200-day just reinforces that this is a short-term pullback within a longer-term uptrend. We start breaking below 4,200. We undercut the 200-day for the first time since March. That is when I would argue we have more of a discussion about potential downside targets. And maybe the next one would be the minimum downside objective based on this head and shoulders top. That would get us down to around 40.50, 40.70, and maybe even further. When I'm looking at the S&P, the momentum is one of the things that just strikes me the most. If you look at the S&P and the NASDAQ, the whole range of the momentum has bumped down a little bit. And I've talked about that at times on the show and different places on Stock Charts TV. I know Arthur Hill, one of our longtime Stock Charts contributors, just wrote an article this week sort of addressing that range, and now the whole range has started to bump lower. So check that one out on our articles page if you haven't seen that one yet. Just talking about some of the key, metrics, I would say the semiconductor space is an important one. We're going to look at the SMH here for a minute. Now, there are two sort of pretty liquid semiconductor ETFs, the SMH and the SOX SOXX. And both of those, I think they're relatively interchangeable. They're structured a little differently, weighted a little differently, but not enough to really, I think, spend too much time debating. I think it's more about the trend in these semiconductor stocks. And I think semiconductors have followed the path that our major benchmarks certainly have, which is this head and shoulders like pattern. The SMHs is a little different. It's sort of a double-headed, weird sort of monstrous thing that's happening here. So it's not a perfect head and shoulders top like we may see on the chart of the S&P, which I think is pretty classic. This one's a little different, but still the idea is the same, right? We rallied up to about 160 for the SMH. We pulled back here in mid-August. On that next rally, we stalled out around 157, so did not make a new high. Now we've actually made a new low. We've undercut this support level from the August low. So the reason why the SMH I think is really interesting to watch here is because now we're kind of at a really crucial point, right? We've broken down through this support level. We actually gapped lower a couple of weeks ago, gapping below 145. And now actually trading right back up to that point. And so, this week we've basically been chopping around that same level of support, which has now become resistance. The momentum has certainly shifted lower. And one of the things that strikes me about the chart of the SMH is just the classic bearish momentum divergence. That's where you have higher highs in price, where you have lower peaks in momentum. Sort of the idealized version is we're overbought on the first attempt. We are not overbought on the second attempt. It all kind of lines up. And so June into July really was showing signs, some of the early warnings, I think, of a market that was nearing an exhaustion point. We then rotated lower, right? Lower highs, lower lows. So at this point, I would argue that this main trend is lower. We're below a downward sloping 50-day moving average, but now we're kind of in that limbo between a declining 50-day and an ascending 200-day moving average. And so, of course, this can go on for quite some time, but at some point you would assume we either break back above the 50-day moving average, which, similar yesterday we talked about the chart of Tesla and TTD, Trade Desk. Those are one of our 3 and 3 charts show those two coil patterns. Similar kind of idea here, right? When you're trapped between these two moving averages is at some point you either break above the 50-day, indicating that buyers are now taking control. People are willing to pay a little more for semiconductor names than they have, or we break below the 200-day. And if that would happen, I think that opens the door to much further downside potential. Now, overall, what I think is more likely, I would say down rather than up, only because the momentum is weak, the trend is down. So I'm just going to assume that persists. When that changes, that's when things can get really interesting. So 150 may be an important level to watch, and above there, the previous swing highs, of course. See if we can make a new swing high, a higher low. Those are the things that would make that chart look a little less negative and more positive. Now, NVIDIA, of course, sort of the main name, and as a preview, tomorrow on Friday's show, we're actually doing a special top 10 charts to watch in October 2023. Here's your teaser. One of those 10 is this chart, NVIDIA. So I won't talk too much about it. You should watch the special tomorrow, but I'm very intrigued on stocks that have not broken to a new low yet, right? The S&P, the SMH, a lot of individual charts, Microsoft, Apple, so many that we could cite, made a new high here in the summer, but then now have undercut the July or August low. NVIDIA is one of those small number of stocks that actually has not broken down there, particularly in growth sectors like technology. So chart like NVIDIA, 400, a crucial level for now holding it, which is encouraging. Now, others looking very different in that space. AMD, of course, has undercut its July and August and September, now making another swing low. This is one of those charts. I don't want to say that what we do as investors is ever easy, because it's not. But I will tell you that sometimes the charts are pretty straightforward. I would say the chart of AMD, if you connect the highs in June, August, September, now early October, it's a real stable trend line that you can identify. And what I was taught is once is chance, twice is coincidence, 3 times is a pattern. And that was a way of just describing that the more you test a trend line, the more you continue to push back and find resistance at a declining trend line. That just reinforces that is a very good visual representation of the pace of this downtrend. We keep making lower lows and lower highs. At some point, that pattern is going to stop and we're going to break above the trend line. And that's what I'd be looking for on the chart of AMD. Now, what's happened is we're kind of at a crucial juncture on this chart as well, because now we've recently bounced off of the 200-day, which on the surface is pretty encouraging. I'm encouraged by the fact that AMD has bounced off of the 200-day and now trading back above $100. So what happens? Do we break above that trend line resistance, or do we fail to hold the 200-day moving average? This is a dead cat bounce before the next leg lower. I think that's a really important chart to watch here. Intel, very different. And when you think of the semiconductor space, it's sort of like most of the semiconductors, and then Intel a little more established and a different dynamic to this chart. If you look, it tends to be an outlier. And again, when I'm looking at the chart of NVIDIA, a stock that's making lower highs and now starting to test support, charts like AMD that are now in established downtrends, I'm struck by how Intel is in a pretty classic uptrend, right? Higher highs, higher lows, recently broke above the swing high, we'll call it around 37. Now it's pulled back a bit, but still making a higher low. The moving averages are sloping higher. The momentum is strong, but not excessive. The relative strength is improving. So there are areas of the semiconductor space that actually look just fine, but a lot of them do not look like Intel. It's very much the outlier. Wanted to finish off just talking about the consumer staples sector, one of my favorite ratios. And we've talked about this with a number of my guests in different ways, but one of my favorite charts to track in terms of overall risk assessment is consumer discretionary versus consumer staples, where I like to say things you want versus things you need. Here's the chart of the XLP, and you can see it's been accelerating to the downside in August and September. So while consumer discretionary, the XLY is maybe not the strongest chart I've ever seen, consumer staples are so weak that the relative performance is still very much favoring consumer discretionary over consumer staples, even on an equal weighted basis. So it's not just the Amazon effect or Tesla or those that are holding up well. It's on an equal weighted basis. You're still seeing consumer staples underperform pretty dramatically, actually. And I'll highlight some of the names that are really breaking down today. Mondelez International is one of the food products named. This particular group has struggled for quite some time. Charts like Hershey's at one point, one of my favorite charts to highlight, the beginning of 2023, just breaking out and looking so strong. But just look at this incredibly persistent decline on the way down. A lot of names in this group are having a similar sort of drawdown. Mondelez in particular bounced off of the 200-day and then kind of rotated lower, and then just the nail in the coffin as we continue to push lower. It's oversold right now, and that leads me to think, all right, let's look for signs of bottoming, but I'm not seeing anything like that just yet. Beverages, soft drinks tend to be a pretty good defensive play, but we're not seeing strength in charts like KDP. This is actually testing a new 52-week low. It actually might have certainly made a new closing low for the year here today, getting down to around $30 a share. Again, also oversold. But again, what I'm seeing here are declining moving averages and a fail to bounce above resistance given the opportunity to do so. Getting to other types of beverages like beer, we have Molson Coors, ticker TAP. Same thing. It's similar to like an AMD. It's testing the 200-day moving average, but down another 6+% today. And overall, you're seeing the momentum more weak. You're seeing it fail to get above moving average resistance. I think charts like this are better off avoided until you see signs of accumulation. And unfortunately, for consumer staples, I'm really not seeing those broad signs just yet. That's our market recap for today. I'm going to bring on today's guest in just a moment. Jesse Felder is one of my favorites. Always brings some good long-term charts to help us put things into context. Before we talk to Jesse, a couple quick announcements. First off, our mailbag. Would love to hear from you. We are here to answer questions about the Stock Charts platform, about technical analysis, about market history, behavioral biases, whatever it is. We are happy to address your questions. Our email is thefinalbar@stockcharts.com. On the Twitters, just tag us in a comment @FinalBarSCTV. And here on our YouTube channel, just drop a comment below the video you're watching. Here during our live broadcast, just put a question in our chat. We will sweep all of those questions, get them in the mailbag if we don't get to them during our presentations, and we will hope to answer one of your questions in our next mailbag segment. That'll actually be Monday of next week. Also, as a reminder, we had a lot of fun on our live Q&A just yesterday. Every Wednesday, 1 p.m. Eastern, I set up in our podcast studio, have a couple charts queued up, and then it's all driven by the questions that come through our chat window. We had a very lively discussion just this week. A lot of questions about different patterns, different pullbacks, and what sort of indicators can help us identify a bottoming phase. Don't forget to tune into our next one. And on our YouTube channel, there's a little live tab, which will show you all the upcoming live events like this show and our next live Q&A, which will be next Wednesday, 1 p.m. Eastern. I want to welcome on today's guest, Jesse Felder. Jesse's been a frequent guest on Stock Charts TV. He's the founder and editor of the Felder Report, coming to us from the coast of Oregon. What a beautiful part of the country and a wonderful time of year to be there. Jesse, great to see you. How are you?
It's great to be back. I'm doing well. It's a lot more fun to be there in the studio with you, but I guess this will have to do this time.
Last time it was so fun. That was our first time meeting in person, Jesse. It was a real pleasure, and I'm good to talk to you virtually. I'll take it anytime we can do it. This market has been a challenging one, a frustrating one for a lot of investors. We've now been sort of in a pullback mode in the third quarter. Now we're entering into the fourth quarter. A lot of people are sort of wondering what's to come as we talk about, Fed rate hikes and all of that. When you take a step back from the conditions here, what are you seeing? What does it tell you about the overall momentum with different asset classes?
Well, I think the thing that's been on everybody's radar is the move in the longer term end of the yield curve. 10-year yield I've been watching specifically, you've been seeing pushing towards 5%. And one of the indicators I look at is just a stock to bond ratio, SPY to TLT. And that thing on a longer term time frame, monthly, quarterly time frame, has gotten as overbought as it's ever been. And so that starts to pressure, falling bond prices pressure stock prices. But I think the first chart that I elected to share with the audience this time is basically just shows how it's not just interest rates, rising interest rates that end up pressuring stock prices. It's when you get rising interest rates, a rising dollar, and rising oil price all together. Those things are usually a pretty good leading indicator of earnings over the next 12 to 24 months. And if the stock market is a discounting machine, is trying to look forward, what are earnings going to look like over the next 18 months? And when you look at these three indicators, they have a pretty good track record of telling you when they rise strongly over a period of time, it really puts a lot of pressure on earnings over that kind of 18-month time period. So I think what we're looking at right here is not a stock market that's necessarily just wrestling with higher discount rates and whatever a discounted cash flow model or those types of things. It's a stock market that's wrestling with the forward earnings picture. Analysts right now expect we're going to see a strong rebound in earnings over the next few quarters. But this, like a composite of interest rates, oil prices, and the dollar, suggest earnings could likely disappoint over the next few quarters.
Ooh, not a great long-term view there, and I totally get it, and I love this perspective of showing how consistent that's actually been, that combination of factors. Talk to us a little bit about valuations, because that's been one of the questions that's come up, certainly with the rally that we saw in 2023. What do you see about valuations right now? We're looking at the PE ratio for the S&P 500. Talk us through this one.
Yeah, that blue area in the middle of the chart is the price to earnings ratio, and you can see it. We had a kind of little craziness during COVID there, but outside of that, you can see it's basically traded in a range from like 17.5 to 25 times earnings, and we're kind of closer to that, the top end of that. We were recently right around that 25 times over the summer, which suggested the valuations are on the high end of the last the range of the last 10 years. And that was, part of it. The market is just discounting this rise in earnings. Like if earnings are going to really rise strongly over the next couple of quarters, then stock prices are going to kind of grow into that valuation. But if it turns out that earnings, on the bottom of the chart, that green area, are actually going to resume their decline because of these leading macro indicators, then it turns out that maybe the PE ratio has been too high, and we could be heading down to a kind of a lower valuation and having to discount, a more negative earnings picture going forward. So I think the combination of high valuations and a kind of a bearish picture for earnings going forward are kind of help to explain what the stock market's wrestling with right now, and probably what the next 12 to 18 months looks like for stock prices.
It's so interesting, Jesse. I really appreciate these charts. I feel like earnings kind of come in and out of investors' awareness depending on where we're at. I feel like I haven't heard a lot about it because we've been talking about the Fed and interest rates and all that. You're kind of bringing it back in and recognizing how these conditions have tended to impact earnings and impact valuations. Before we went live, Jesse, I was asking you about the current market and how you were making sense of things. You drew a really interesting comparison of where we're at now back to 2018. We have a weekly chart of the S&P. Can you just explain that relationship and why you're hearing an echo of that 2018 period right now?
Yeah, I think, in 2018, a lot of people were, the Fed had been raising interest rates for a period of time. We had seen that was the last time we saw the 10-year yield get even anywhere near like 3%.
Mm.
And, that rising interest rates started to pressure stocks. And then it looked like it was going to start, potentially creating problems for the economy. And Jay Powell, even in the face of all that, said, doesn't matter. We're basically on autopilot, especially in terms of quantitative tightening. We're going to let the balance sheet run off, come hell or high water. Then the market reacted poorly in the fourth quarter of 2018, and that forced the Fed to kind of back away from that quantitative tightening standpoint. I think we're in a really similar time right now in terms of where we are in the tightening cycle. We're probably near the end of the tightening cycle, but Jay Powell said at the last meeting, even if we're done raising interest rates, we're going to continue to allow the balance sheet to run off. And I think that is a liquidity drain on the markets, broadly speaking. That also is another thing that the markets have to fight with, is that if interest rates are going up and the Fed's still draining liquidity, that could be problematic for the fourth quarter here.
Yeah, and why my palms are sweating a little bit as you're saying that. 2018 was the last time we really saw a decline in the fourth quarter to that sort of magnitude. I usually think of the fourth quarter as being remarkably strong, but 2018 was one of those, sort of different years where the fourth quarter actually tended to be kind of challenging. We ended up having a pretty significant low in December of that year. The last time you were on, we had you in the studio, as you mentioned, which was a lot of fun, Jesse. And we talked a lot about precious metals. Gold has been such a fascinating ride over the last 12 to 18 months. I feel like it's rallied and it's come back, but at the end, you're sort of, left with the question of what's next. The GLD gold stocks have really started to rotate lower here in September. When you're looking at the chart of the GLD, do you see reason for optimism or something to stay away from here?
Yeah, I shared a lot of longer term charts, last time we talked about, for the gold price, and I still think those are all intact. That to me, we're seeing, corrective moves within a longer term bull market for the gold price. I think in the short term, what's interesting now is we just saw this week the first, I call it a McClellan buy signal, kind of in honor of Tom McClellan, who came up with this signal. It's when you get GLD oversold on the daily chart. So RSI below 30 on the daily chart, and the 5-day rate of change drops below negative 2.5%. It's not kind of an infallible, it doesn't always work, but a lot of important lows in the gold price are kind of associated with these kind of panic selling environments where you see this signal triggered. I think especially when you pair it with really deeply negative sentiment like we're seeing in gold right now. I mean, you look at like the daily sentiment index or something like this, and we've had multiple days of single-digit percentage bulls, 8% bulls. You could probably look at the bullish percent index too, which is kind of a point and figure, model, which is also kind of a good measure of oversold. And a lot of these things are kind of pointing in the same direction, which we've seen a lot of negativity in the short run that usually is kind of associated with the tradable bottom.
Yeah, it's so interesting. We highlighted on yesterday's show, we dug into some of the breadth indicators. I totally agree. A lot of these going down to similar levels that we've seen during pullbacks, a lot of times sort of toward the end of this. This is the bullish percent index that you mentioned, sort of getting just below 30% here again this week. So with that in mind, Jesse, and particularly with your initial comments about rising rates, about the dollar, and what that means for earnings, where do you see opportunities, if any? You mentioned gold as a potential reversal. Any areas of the market, is this a time to be defensive and just try to sort of wait things out? Do you stick with some of the growth areas of the market, like an Alphabet, that are actually holding up? Like, where do you try to navigate? Where do you look for opportunities here?
Generally, I'm a believer that we're in a long-term commodity super cycle. So I think, it makes sense to buy dips in things like energy and precious metals, and to sell rips in financial assets in the bond market and in stocks more broadly. I think what we're likely headed for is, if this kind of 2018 idea plays out or echoes again, the Fed will be forced to kind of pivot at some point. The strong dollar trade right now is based on this idea that interest rates going to be higher for longer. The Fed is not going to be able to back off of this hawkish policy. But I think with long end, if the long end continues higher in terms of interest rates, it's going to force the Fed to intervene in some respect, which would be very dollar bearish and bullish for commodities and precious metals specifically.
That's a great answer. We're almost done here, Jesse. We have to wrap up, but I'd love to ask just one more question. As we have this market in decline, we've highlighted some of the different indicators, breadth indicators, different measures of momentum, support. What's that one indicator you find that you're looking at the most to try to navigate this downtrend and try to figure out when things are starting to turn? Is there a particular chart that you find yourself looking at in this kind of environment more than anything?
Absolutely. For me, the key to where the stock market is going to go in the very short run is risk appetites. What are risk appetites doing? And so I look at, there's two charts specifically on stock charts that I look at, and that's the LQD relative to IEF. It's the basically bond market risk appetites, and HYG relative to IEI. Those are just ratio charts and show our investors, selling junk bonds faster than they're selling shorter term treasuries. Are they selling corporate bonds faster than they're selling treasuries? If you see that develop, you see these ratios start to break down, that's a sign that risk appetites are really turning south. That usually leads to the stock market following suit.
Brilliant answer, and I love that thing. And when markets tend to get into that bearish phase, I know from my Fidelity days, we would always go to the fixed income desk. It's particularly the high yield desk. They were always laser focused on risk, much more than we were. So I love that answer, Jesse. This is a pleasure as always. Really appreciate your thoughtful perspective and some really good charts to illustrate them as well. Be well there in Oregon, and we'll talk to you again soon.
Thanks, Dave. Always great to chat with you.
That's Jesse Felder. Jesse's the founder and editor of the Felder Report, coming to us from the Oregon coast, which is an absolutely stunning part of this country. Really interesting comments, and I love his discussion. I feel like every time I talk with Jesse, I learn some new thing. I had not heard about this McClellan signal using the GLD, using RSI and rate of change. I made a note of that one. That's a really interesting one. And it's so fascinating how the short term fits into the long term. And I think if you get anything from my discussion with Jesse, which I think there are a lot of great nuggets of wisdom in there, thinking about the big picture and then the short term, the tactical, how that fits into the overall trend. Really good way to approach an uncertain market like this. Appreciate it as always from Jesse Felder at the Felder Report. We got to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We haven't talked about sentiment too much, maybe volatility in terms of the VIX. We talked about the MOVE index recently. We have some additional questions that came in after Jeff Hughes earlier this week was referencing the MOVE index. But one of the other ways I like to look at sentiment is in terms of survey data. The Name Exposure Index is the National Association of Active Investment Managers. It's a survey of money managers, and the question is essentially, what's your allocation to equities? And it's an interesting one because it's not as much individual investors like the AAII survey. This is money managers. And so as a result, tend to have a little different perspective on risk versus reward and how they want to be positioned. What's interesting to me is we are at almost the lowest levels that we've seen in 2023 as of this moment. We're just around 36% equities. If you think of a normal allocation for equities, according to this survey, usually around 70%. We're pretty underweight equities, and that's been the case for quite some time. Really since the July peak, where the allocation got to just above 100%, from that moment on, it's gone down pretty quickly. So even with this choppiness, even with the bounces higher, it's never really gotten above 60%, and now we're back to some of the lowest levels that we've seen since the middle of 2022, since a much more bearish phase. So the positioning is very much risk off using this particular survey right now. I find that as not a contrarian buy signal, but more of a cause for concern, because this survey usually gets negative when the market starts to decline because money managers are going a little more risk off. So for now, it's suggesting that it's the case with the Name Exposure Index. Chart number 2, Vertiv Holdings, VRT, a name you may not be familiar with. It's about 15 billion market cap. It struck me because it's going up, and this is actually the top ranked stock in our large cap scooter rankings as of this week. So I wanted to highlight a name. What's so interesting is we talk about charts like NVIDIA, mega cap names pulling back and testing support. We talk about consumer staples and charts like Disney and Paramount and these established downtrends. There are charts out there like Murphy USA, which we've highlighted recently, like Vertiv Holding VRT, that are just kind of going up. So it's always a good time to own good charts. That's one of the things I like to remind people, but especially in this sort of uncertain environment, stocks holding above 2 upward sloping moving averages, stocks with strong relative strength, these are names to pay attention to. VRT for now certainly fits the bill. Finally, Starbucks. And again, I'd encourage you to tune into our show tomorrow. We'll do the top 10 charts to watch in October 2023. Starbucks is not one of the 10 that I will be sharing with you, but it is a good example of the type of names that I think are important to watch here. Starbucks has just given so many clear signals of a rotation from a bullish phase to a bearish phase, or what I call an accumulation phase to a distribution phase. Look at how it established support and then broke to a new low. How it was above 2 upward sloping moving averages, now it's below 2 downward sloping moving averages. The momentum was relatively strong in the bullish phase, now it's more in the bearish range, not getting above 60 on rally. So in a chart like this, we know the trend is down. Now we're just looking for signs that that downtrend is reversing. So I asked Jesse Felder, my guest today, about what chart he would be looking at. I loved his answer about looking at some fixed income ETFs to look at relative risk assessment or risk awareness. I like to just keep it simple and look at names like Starbucks and see, when do they not go down anymore? When can I tell that buyers are actually coming in? Breaking above trendline resistance, breaking above a declining 50-day moving average. Those are some of the signs that I think it's good to be patient and wait for. But once those things happen, that tells you that buying power is starting to emerge and people are starting to buy in on the weakness of charts like Starbucks. Folks, that's a wrap for today. Thank you so much for joining us every weekday after the close. Special thank you to Jesse Felder of the Felder Report, joining us from Oregon. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.